That way I can advise you on what to do to get that cleaned up before you're ready to go. Because usually that's something that can be cleaned up. I probably do 3-4 credit cleanups a month for people. So I mean, it's amazing. The little things, and to be able to educate you on how that all affects too, affects your credit scores. And I'll talk to you a little bit later about how credit scores can affect your interest rate, how it affects your PMI rate, all that type of thing. So it's really good to be pre-approved, and that's the first step that you want to do. That way you know where you're at. And it's real simple to do that. As far as your budget goes, sometimes people, I let people make up their own decisions, but if I see people like get a little crazy, I'd be like, this will be, you don't want them to be, I don't want anybody to be like totally cash poor. Who wants to be, to go to a house and then you have nothing left? A person making $30,000 a year and he's spending half his money on his house. I don't know how you do that. It's a hard thing to do.
What is the percentage it should be?
Well, the way that it works, what it can be, okay, with FHA, you can go up to 55%. So if your income is $1,000 a month, I can go up to $500. All your payments together can equal $550. With a conventional loan, it kind of varies. It basically, what I do is I take your credit, your income, your assets, and I run it through this underwriting system. It's like this huge matrix, and it knows, it takes into account all the risk factors of including your credit, how you're paying that, how long you've had it, how much income you have, disposable income, how much assets you have, and if you have, after you've done paying the down payment, if you have anything left over. It takes all this stuff into account. So that goes anywhere between 45 to 50%, depending upon the risk that's involved. But usually, a lot of times, I like 45. So that's why what I was saying is that FHA, a lot of times I can get things approved that I won't be able to get approved on a conventional loan through FHA. And it might make sense for a person. Sometimes I can't document certain incomes. It's hard to document it, so I can't count it. And that's another good thing for you guys to know too, is if I'm going to be able to count your income and what you need to do on that end of it as well. It's good to know that up front. And then, the first question I always ask is is there a payment amount that you're looking for, or a particular price range that you guys are looking for? And then I'll build your pre-approval based upon some of that stuff. And then maybe you'll say, hey, Ray, I'd like to get a $200,000 house. And actually, you're approved for $400,000. I do let you know that too, and we kind of go through the payment scenarios and how much each $1,000 costs you. If you were to, hey, what if I instead of a $200,000 loan, what if I got a $230,000 loan? What would that look like? And we can kind of go through that too, because sometimes you go in and you want to put a bid on a place, and of course you want to get it for $200, or you want to get it for $300, whatever. But if it's listed for $350, sometimes you might have to go up to $335, and it'll surprise you on how little money that costs you. If you really like the house and it's a good deal, just to do it, like whatever, I'll bite the bullet for the extra $100,
What's the factor now at today's rates per thousand on mortgage?
It's about $4.75 per thousand. So if it's $100,000, just take the 3 zeros off times 4.75, so it'll be $475 for $100,000 is what your principal and interest payment would be, on that. Does that make sense? So, or if you just want to round it off, $5 is good. Just use $5 for every $1,000. Okay, instead of I'm going to offer $5 or $5,000 more. Okay, that'll cost me $25. Okay, we'll do it for the extra $5,000. That's how you can do that real quickly in your head. So we just kind of went through how much home you can afford. These are just general numbers, but the actual numbers are the 45 and the 55 for the FHA. So things that you're going to need to get pre-approved. And I got a couple mortgage tip sheets there too. And one of them is just the mortgage process. You guys can read through that. But normally what I'll do is if you're self-employed, I'm going to get your taxes. Are you self-employed or no? No? Okay. You guys are easy. You W-2. Just usually need pay stubs. You want to make sure that you don't write anything off. Sometimes people write off like business expenses due and anything. Oh, I love you guys. You guys are simple. I love simple. Simple's really nice. And so when they have this business going on, that
Same
business.
company too.
Oh, wow, okay. Alright. That'd be real simple. Yeah, when people have like this business going on the side there, another business on the side there, and they write off this, write off that, then you got all these things, you got all these balls in the air, you got to make sure. And then I do a lot more heavy documentation for you guys. It'd be real simple. I can just take your pay when you just say, hey, this is my salary. If it's a salary, if it's an hourly rate, I might ask for pay stubs and a W-2, something like that. Assets, what we're going to do is we're going to get your bank statements. A lot of times I'll just say, hey, hey Joe, what do you have in your Chase account or whatever account that whoever you work with or whoever you bank with? How much is in your checking savings? You have a 401k. I'll kind of get all that stuff. Then I pull your credit, get all the credit information. And then when we're ready to do the loan, I'm going to ask you for a lot of documentation. I'll ask you for 2 most recent pay stubs, get your 2 most recent bank statements, we'll get your W-2s and tax returns from the previous year. And then if you got anything else going on, I'd ask you for additional documentation. We're going to do an appraisal on the property. So an appraisal, basically, we have a guy that goes out, looks at the property, takes pictures of it, does all the measurements. Then what he or she does, then compare it to other homes that are similar that sold recently. Right now they're using homes that sold within the last 3 to 6 months. So we're going to look at homes in that neighborhood, and so when you get it, you'll see the appraisal. They're going to compare it to the ones that are most like the home that you're looking to buy, and then they'll take minus, plus, depending on a little more square footage, they got a finished basement, or whatever the case may be. They'll take that into account and give you a value. A lot of times it comes in right what you're buying it for, so they do make it, cater to whatever your number is for the most part, but sometimes it comes in higher, and every once in a while it comes in lower. So if it comes in lower, then you got a dilemma, Either you gotta, buy it for what you paid for. Let's say that you're going to buy a home for $300,000 and it came in at $290,000. Okay, either you can buy it for $300,000 and put an extra $10,000 down on the property, or you got to negotiate with them, maybe meet halfway, or they got to come down to $290,000. So, because when I'm looking at it, or our underwriter's looking at it, we're going off the value, the appraised value of the property, or your purchase price, whichever is less. You never get the benefit, you'll find in this business, you'll never get the benefit of greater or less. It's always in the worst case scenario. We always look at the worst case scenario. We're pretty negative people in the mortgage business these days. Okay, so our credit scores and an overview of that, just kind of reviewing what credit's about, what you need to know about that. So credit scores, the range between 350 to 850. Okay, what we do is we pull 3 credit bureaus. There's 3 different bureaus. So Experian, Equifax, and TransUnion. What we do is we take the middle score. We don't take the average, we take the middle between the 3 of them. Okay? Different things that affect your credit, okay, your credit score. If you look at the next page, what determines your credit score? 35% of your credit score is determined by your payment history, how you pay your bills. If you pay them on time, if you're late. Now, if you're late, you get crucified. If you have a 30-day late, if you're like 10 days late, it does not matter. It doesn't make a difference. But if you're 30 days late, 60 days late, or 90 days late, 90 days late is like a mortal sin. Okay, you don't want to have that mortal sin. And so that 35% of your score is based upon that. 30% is how much you owe. So if you have a credit card and your limit is $1,000, and you have greater than $500 on that card, it's going to hurt your credit score a lot. You want to always be under 50%, okay? Or have them raise your credit score or your credit limit, so that you're not in that situation. There's people that have these credit cards for $500 and then they have them maxed out. Oh man, it really hurts your credit score. That's 30% of your score, so you have to realize that. So a lot of times, that just doing a few things with those things alone can help people out and help you out with your interest rate. How long you've had credit history? Sometimes people will do really silly things when they go out and get a mortgage. They close all their credit lines because they think, oh yeah, that makes my credit look bad. No, actually, that's the opposite. That is true. You want to keep the credit lines open so you have more credit history. Because if all of a sudden all you only have is, because once you close them, they no longer help your